Leo, how much percentage of a play can there be altogether?
Max, you can only sell 100% of anything.
And how much of Springtime for Hitler have we sold?
25,000%.
In The Producers, down on his luck Broadway impresario Max Bialystock and his hapless accountant Leo Bloom sell more shares in a play than is mathematically possible. The CEOs like Frank DeBrucke have complained for years that the same producer-style accounting is at work when abusive naked short sellers target small companies.
20,800% of our company was traded in a single month. The shares weren't available. They weren't there. There was no way they could be trading.
In March 2005, the Senate Banking Committee confronted then SEC Chairman William Donaldson with a story about Frank DeBrucke's company, the Nevada-based real estate holding company Global Links. An investor named Robert Simpson had set out to prove that small companies were indeed frequent targets of abusive naked short sellers. Simpson placed an order for $5,000 worth of stock in Global Links. That got Simpson ownership of all 1.1 million Global Link shares in the market. Not some of them, all of them.
There were no shares available to be borrowed, and yet in 2 days there were over 50 million shares traded. That's clearly something that needs work.
I was absolutely blown away when I bought 1,282,050 shares, which equated to 111% of the issued and outstanding. I just couldn't even fathom that. So it wasn't just crooked, it was Wild West times 10.
The day all this started, trading in Global Links opened at 10 cents a share. Within a second, the price dropped to a penny. An hour and 16 minutes later, Global Links stock was trading at 8/100ths of a penny. Prices dropped 99% in less than 2 hours. Global Links CEO Frank DeBrucke wrote shareholders, telling them the selling of Global Links shares was evidence of illegal trading. And when that occurs, he said,
the company cannot meet its goals and shareholder equity is diluted so that brokers can line their pockets with illegal cash.
The same conviction motivated Patrick Byrne to hire 6'6" John O'Quinn, one of the few attorneys in the country tall enough to look him in the eye and, by reputation, a giant killer. In Texas, they call O'Quinn the billion-dollar man because he won billion-dollar judgments against makers of silicone breast implants and fen-phen and against big tobacco.
The deal is rigged so bad, I can make this statement safely. You have more chance to be treated fairly in a casino in Vegas than you do in the stock market. The security industry has things rigged to where they can deal from the bottom of the deck regarding your stock and your money.
O'Quinn's co-counsel is another Houston-based attorney, Wes Christian. Together they represent some 20 U.S. companies that all claim damage from naked short selling, including Overstock, Sedona Corporation, and Taser. They represent Overstock in a lawsuit seeking $3.5 billion in damages from Wall Street's biggest prime brokers, accusing them of executing short sales with no intention of delivering stock, causing Overstock's share price to drop. All the accused have declined comment on pending litigation.
If you're a short seller and you abide by all the rules governing short sales, then fine. It's legitimate, it's legal, it's proper. That's not what is going on Wall Street. What's going on Wall Street in our cases, and we're now seeing in many other companies, is a rigged system.
But where Byrne and his lawyers see naked short sellers driving down stocks and destroying companies, many on Wall Street see something far less threatening.
Well, I think the phrase I would use would be red herring. It sounds ominous, it sounds nefarious, and by and large, it's a non-issue in the marketplace.
Jim Chanos runs Kinnikos Associates, a New York hedge fund known for short selling. He says he's never naked shorted a stock. Chanos is among those on Wall Street who say CEOs who complain about short sellers are usually trying to divert attention from fundamental problems.
And they often find that short sellers a convenient excuse as opposed to perhaps their own failings in execution to blame for share price disappointment. And that's where I think we see a lot of the Sturm und Drang, if you will, of this issue.
Burns' critics have dismissed him as a conspiracy theorist and have criticized his company's performance. In 2006, Overstock revenues fell 1%. The company lost $97 million. Share prices fell 46%.
I knew as soon as I took him on, it was going to be spun as, oh, this is a CEO who's just mad about his stock price, and if he just, you know, if you only ran a better liquor store, maybe people would stop robbing it.
Burns' battle against naked short sellers led him to one of Wall Street's best-kept secrets, the Depository Trust and Clearing Corporation, or DTCC. It's just a few blocks from here. On average, the DTCC says it processes more than $1.4 quadrillion worth of trades a year. That's more than 20 times the economic output of the entire planet. The DTCC also keeps track of the trades that can fail due to naked shorting.
Speaking at a conference just a few blocks from DTCC headquarters, Suzanne Trimbath, who worked for a subsidiary of the DTCC, explained the corporation's role in U.S. capital markets by comparing Wall Street to Broadway.
Imagine that all of Wall Street is a stage. Then DTCC is like backstage. These are the guys that run the lights and the cameras, the grips and the gaffers, the people that moviegoers really don't need to know what they do, and you don't need to care about it. But we all do need to care about what's happening backstage at the capital markets.
Meantime, Patrick Burns says he received data from the DTCC that stunned him. On January 12, 2006, Burns says the DTCC data indicated that there were 7 million more Overstock shares in circulation than there should have been, a discrepancy coinciding with the steep decline in the company's share price.
So if it's only 7 million shares, it's 35% of our company has been counterfeited. I think I have a fiduciary duty to the shareholders or the people who think they're shareholders to clean this up.
DTCC data obtained from the SEC through the Freedom of Information Act also reveal the scope of the failed trade problem. On an average day last March, failed trades amounted to more than 750 million shares in almost 2,700 stocks, exchange-traded funds, and other securities. In all, the DTCC says about $6 billion in trades can't be cleared every day, 1.5% of the total dollar volume. In this letter to the SEC, Wall Street's Trade Association, the Securities Industry and Financial Markets Association, or SIFMA, says trade settlement failures are only a problem for an extremely small universe of securities. Peter Chepkavich is a former SEC attorney who helped write Reg's show.
To say it's trivial in the context of the entire universe is a meaningless statement. We all want to know more about how many fails there are with respect to short sales and who exactly is failing.
Because trades can fail for innocent reasons, like clerical errors, the DTCC says it doesn't know how many failed trades can be blamed on abusive naked short selling. A statement on its website reads, "While we have data on the volume of fails, we have no information on the underlying causes of those fails." DTCC officials declined our requests for interviews. DTCC members include the prime brokerage firms that control the $10 billion annual stock lending market and are responsible for many of the failed trades. Officials at SIFMA declined to be interviewed too. Up next, is the SEC doing enough to crack down on abusive naked short sellers?